Your retirement shouldn't depend on what the market does tomorrow, and neither should your path to get there. You're listening to 10 Minutes Wealthier from the team at Branning Wealth Management. Each episode, we cover one piece of the wealth planning puzzle because the right moves before retirement are just as important as the right moves during it. Let's get to work.
Welcome back to 10 Minutes Wealthier, the Branning Wealth Management Podcast. I'm founder Jason Branning, and this show's about helping you build a retirement income plan that you can actually rely on. We've talked about why you shouldn't have to ask the market for permission to retire, about how bond ladders work to create an income floor, and today I want to talk to you about something that catches many people completely off guard: taxes in retirement. Most people assume their tax situation will be simpler when they stop working. Smaller income, smaller tax bill, and that seems to make sense, right? Except that's not always the way it plays out. And for some people, retirement brings a tax bill they never saw coming. Well, let's talk about why, and more importantly, what are some of the things that you can do to impact that? Here's the story most people tell themselves about taxes during retirement. They'll say, I'm not going to have a paycheck anymore, so my income will be lower. Lower income means a lower tax rate. I've been in the, top tiers of brackets my whole career. Now, at last, retirement will finally be cheaper from a tax standpoint. And sometimes that is true. But many times it's not. And here's why. Most people who've done a great job saving for retirement have a significant portion of their money in traditional IRAs and 401ks. That's pre-tax money. It all went in before taxes, and it grew without being taxed. Therefore, at some point, the IRS is going to want their share. When you start taking distributions from those accounts during retirement, every dollar is taxable income. And if you've done well, if you've accumulated a meaningful amount, those distributions can push you into a higher tax bracket than you expected. On top of that, there's Social Security. A lot of people don't realize that Social Security benefits can be taxable. Up to 85% of your total benefit can be included as taxable income, depending on your overall income level. Then add required minimum distributions. Starting at age 73 or 75, depending on what the IRS says for the year you were born, they require you to take money out of your pre-tax accounts, whether you actually need it or not. Those required minimum distributions are taxable. And if your accounts have grown significantly, the RMDs can be substantial. Put all of that together, IRA distributions, RMDs, Social Security, and suddenly the tax picture looks quite different from most people expected during their retirement years. Well, when we talk about diversification in investing, most people think about spreading money across different types of assets, stocks and bonds, U.S. or international, that kind of diversification. But there's another kind of diversification that's just as important, but far less discussed, and that's tax diversification. Tax diversification simply means having money in different types of accounts that are taxed differently. So you have flexibility during your retirement to actually have an impact or some control over the taxation of income year by year. There are essentially three buckets. The first bucket is pre-tax, your traditional IRA, 401k, 403b, money while you're working that goes in before taxes and grows tax deferred, then is fully taxable when you take it out. Most people have the bulk of their retirement savings in a bucket like this. The second bucket is after tax or Roth. You put money in after taxes, the funds grow tax-free, and qualified withdrawals during retirement are completely without taxation. The IRS has already gotten their share and they don't ask for more. The third bucket is taxable. It's your regular brokerage accounts. You've already paid taxes on the money that went in, and you pay capital gains taxes on growth along the way as you sell, or income on dividends or interest, but long-term capital gains rates can often be lower than ordinary income rates, which creates many planning opportunities for this bucket. If all of your money is in one bucket, if it's all pre-tax, you have very little flexibility. Every dollar you take out is taxable income. You have a limited ability to manage your bracket from year over year. But if you have money spread across all three buckets, then you have options. You can choose which account to pull from in a given year based on what makes the most sense from a tax standpoint. That flexibility is enormously valuable, and the time to build it is before you retire, not after. There's a related concept that works hand in hand with tax diversification. It's called asset location. It's about different asset allocation decisions based on a tax bucket. So the allocation is what you own, the location is about where you choose to hold certain types of assets by account. Different investments are taxed differently, and some investments generate lots of taxable income every year, interest, dividends, short-term gains, while others are by nature more tax efficient. They generate less taxable activity year over year, and the tax hit comes later when you sell. Well, the idea behind asset location is simple. Put the less tax efficient investments in your tax advantaged accounts like an IRA or 401k, where that type of activity does not create a tax bill every year. And put more tax efficient investments in your taxable brokerage account where they're already well suited to sit. Done well, this can meaningfully reduce the drag of taxes on your portfolio every single year without changing your overall investment strategy at all. It's not about picking different investments. It's about being thoughtful about where you hold those investments that you already have. Between tax diversification, that is which accounts you have, and asset location, that is what you hold in each type of account, you can start to build a portfolio that's working efficiently for you in the background, year after year, regardless of what's happening with any single fund or holding. Here's something I need to point out because I think it's important and it's often overlooked. It's a truth in financial planning. People spend an enormous amount of time and energy worrying about their investments. Should I be in this fund or that fund? Is this manager better than that one? And all of those things matter a little. If one fund outperforms another by 0.5% over a year, it can be real over a long period of time, but it's also relatively small. But you try to compare that to your tax rate and trying to control the rate of your taxes through proactive tax planning, like asset location, withdrawal sequencing, Roth IRA conversions in the right window. All of these can lower your effective tax rate by several percentage points across your retirement years. That can dwarf this 0.5% difference between Fund A and Fund B. Well, I'm not saying investment selection doesn't matter. It does matter. But I'd encourage people to redirect some of the energy that they spend thinking about that fund question and that 0.5% difference between two reasonable fund options. That often just becomes noise. The difference between a tax-efficient retirement and a tax-inefficient one can be more substantial. And that's something that you actually have some control over. The next question to ask yourself right now is, do I know what my tax picture will look like during retirement? Do I know where my income will come from and which accounts I'll pull money from first? What will the tax consequences look like from each source? Well, if you don't have a clear answer to that, it's worth getting one because the decisions that you make in the 5 to 10 years before and after retirement can have a meaningful impact and make quite a bit of difference in how long your money lasts and how much you get to keep, and also how much you get to extend to future generations. If you'd like to learn more about how we approach tax-efficient retirement income planning, visit us at bramwealth.com. And if it feels like a fit, we'd love to have a conversation. Until then, plan with intention. We'll talk soon.
The information shared in this podcast is for educational purposes only and does not constitute investment, tax, or legal advice. Opinions expressed are those of the speaker and may not reflect the views of Branning Wealth Management or its associates. Investing involves risk, including the potential loss of principal. This podcast is not a solicitation to invest. Branning Wealth Management provides investment advisory services under Asset Dedication, LLC, an SEC registered investment advisor. For additional information, including our ADV Part 2A and Part 3 disclosures, visit brandwealth.com.